Hi, thank you for joining us for the Week in Review. We've been off for a couple of weeks and very excited to get back in front of you guys. It is January 6th. My name is Mike Love. I'm one of the senior portfolio managers here at Private Asset Management.
And I'm David Allen, the Chief Investment Officer.
So, David, we're already getting some exciting news this year. The market this morning has reacted to the employment report. Can you give us your thoughts on the market's reaction? Is it valid? Are they overreacting? What are some of your initial thoughts?
So this set of employment data was the first big report of 2023. We're looking at December's employment numbers, and overall, I think the markets have reacted fairly positively to this news. Treasury yields have sort of fallen across the yield curve. We've also seen the dollar depreciate a bit, and equity markets are certainly higher. As we're recording this morning, we're up over 1.5%, in trading so far. So I think the markets are receiving it positively. I think the data in general was also pretty positive.
Are there certain sectors that are seeing a move over others, or is it just pretty much a general market move higher?
Yeah, so overall, we saw 223,000 non-farm payrolls added. A lot of that growth came from the categories that we've seen, over much of 2022 being strong. That's, leisure and hospitality and healthcare. Those were fairly strong sectors again in December. I think one of the big differences in this December data from some of the other data we've seen is that they're actually, the gains weren't as broad-based. We did see some categories which were slowing. One that was particularly worrisome was temporary help, which actually declined by 35,000 in the month. That tends to be a pretty good leading indicator of where hiring is going. And so we want to keep an eye on that as the data comes out in 2023 also.
Let's come back to one of those numbers that you just mentioned, which I thought was pretty interesting. The 223,000 number. Can I get your reaction on that? What are your thoughts on that number?
Well, it certainly, continues the strength that we've seen in non-farm payroll gains through the second half of 2022. It was the 9th consecutive month that we've actually exceeded the economist consensus estimate for non-farm payroll gains. I think those economists are going to need to be a little bit more aggressive in their estimates if they want to be, sort of continue to be thought of as a pretty good estimator leading into these reports. But it's a pretty strong number, one that suggests that the labor market is still, pretty robust. And as we enter 2023, there are certainly more concerns about whether or not the U.S. economy is going to enter a recession sometime this year. And this, as we exited 2022, it seems like the labor market was strong, which would suggest that, maybe those risks are slightly lower than we thought before the data came out.
But what about the wage growth and the fact that that's slowing?
Yeah, I think that's the most important thing from the Fed's perspective in terms of what they're looking at in terms of forming their monetary policy over the first half of this year. They've really been keying on in recent statements wage growth and wanting to see that slow, wanting to see better balance between labor market supply and labor market demand. And that wage growth is showing that. I mean, we did see a slowdown in the month-over-month rate of growth in average hourly earnings to 0.3% from 0.4%, and also a decline year over year to 4.6%. So I think that's certainly a good sign. I mean, we saw a pretty significant pickup in participation that was offset by an even larger increase in employment for the month, and so that's why we saw the unemployment rate also fall to 3.5%, which was a 60-year low, I believe. So overall, on the headlines, this was a pretty strong report across the board.
It almost seems like with kind of the pessimistic tone that's been out there, that we're searching for something to react to, and this number seems to make a lot of sense to me.
Yeah, I think so, and I mean, I think there's a lot of positives that can be taken, maybe not quite as many as the market is suggesting this morning, but overall, a good report and something that I think is important to build on in terms of labor market strength in the first half of 2023.
Absolutely. Well, what about the loosening of kind of the financial conditions that we're seeing in the overall fixed income market?
That's what I'm alluding to there. Is I think we have seen markets maybe get a bit ahead of themselves this morning based on this data. It's strong, but it is, again, is it enough that's going to knock the Fed off of the path that we expected from them at the end of last year? As most recently as the FOMC meeting minutes that were released this week, we saw policymakers are very focused on financial conditions and making sure those are tight enough that we actually get the downward pressure on inflation that they want to see. And so when we see the dollar weaken, when we see interest rates begin to decline, that's actually a loosening of financial conditions. That's going to go against what the Fed is hoping to see. So I think from their perspective, they have a couple of weeks before they enter the blackout period for their next meeting. I think from their perspective, they're going to be looking to use their time making public comments to sort of suggest to the market, hey, don't go too far in terms of expecting looser conditions in the future. We still have quite a bit of work here to do on the inflation front.
So it sounds like our new debate is, are they going to raise 25 basis points or 50 basis points? And it seems to me that it doesn't really matter which one they do. It's more of the signal that they give, right? So if they move only 25, wouldn't that signal that potentially they're slowing the rate and that maybe they're towards the top of what they're going to do?
Yeah, I think that's right. I mean, I think whether it's 50 or whether it's 25 matters less than how long are they going to be increasing rates until they pause, and where is that terminal rate going to be ultimately? So more focus there and less focus on meeting by meeting. Is it going to be 25 or 50? We really don't know, and probably won't know until a couple weeks from now when they finally meet.
Okay. Well, let's switch over and talk about something a little bit more entertaining. Let's talk about the House speakership. We've learned this morning that it's the 12th straight vote that didn't go through for a majority speaker. Without having too much fun with this one, why don't you give us your opinion on what's going on there? What are the ramifications? What do you think may happen? Just a general sense on your thoughts.
Right. So, I mean, obviously, I'd just start off by saying, my background is as a financial analyst and an economist, not a political scientist. So, the political ramifications here, I think, are less in my wheelhouse. But I do think, from someone who's looking at markets and someone who's paying attention to the economy, there is some important developments that are coming out in this situation also. Certainly, the House speakership, whoever ends up becoming House Speaker, and whenever that does happen, it seems like that position is going to be significantly weaker, and that creates the potential for some confusion about getting some very important of like sort of the bedrock of what we need in terms of financial markets from the government. Keeping the government funded, raising the debt ceiling, doing those things that are going to be of utmost importance to markets and the economy. And so if there is a less unified front within Congress, and those things are less likely to happen, that is a potential risk that we need to pay attention to. But on the other side, I think one of the things we've said before in these videos is that if we are seeing divided Congress, that does tend to mean that we're going to see less change in the regulatory environment, less change in the legislative environment. That's usually a positive for markets, a level playing field. So that's one way of looking at this. If there's sort of intransience, that is maybe a good sign for markets. But we do want to have at least enough of a unified front within Congress to get those important bits of legislation passed.
Wow. Yeah, definitely some turmoil there. Okay, let's fast forward here to next week. We have some important economic numbers coming out. I don't know if you wanted to hit on a few of those.
Sure. I mean, so the employment data this morning was the first big important report. The next one comes next week, and it's the CPI data for December. That I think that coupled with this morning's employment data are going to tell us a lot about where the Fed is headed at their next meeting at the end of this month. They'll be making their announcement on February 1st. So on Thursday, we'll have that CPI data. We are expecting core inflation to slow both on a month-over-month. Core inflation is actually going to accelerate just slightly on a month-over-month basis, but on a year-over-year basis continue to fall and actually end the year with a 5% handle, down from 6% that we saw in November.
Okay, well, we'll look forward to that CPI data coming out on Thursday. And just wanted to thank everyone for joining us. And please like and subscribe if you're enjoying the videos. We also have recently sent out a company newsletter that has 3 brand new articles in there as well to browse through.
And those articles are actually going to be included. If you receive notifications of these weekly videos by email, at the bottom of that email, we're going to have links to those 3 articles also. So if you hadn't get a chance to check those out, you can take advantage there in the email.
Thanks, everybody.